One company, one decision, $182 billion of taxpayer money, and the entire global economy on the edge of total collapse. In September 2008, the United States government did something it had never done before. It bailed out an insurance company, not a bank, not a mortgage lender, an insurance company. AIG, American International Group, the largest insurance company in the world. And the government did not just bail them out a little. They handed AIG $182 billion of taxpayer money, the largest corporate bailout in American history. Because if AIG collapsed, every major bank in America was going down with it. Every pension fund, every investment portfolio, every retirement account, the entire global financial system, gone. This is the story of AIG and the reckless bet that almost ended the world economy. To understand what AIG did, you have to understand what they were selling. AIG was founded in 1919 in Shanghai, China. Over the next 80 years, it grew into the largest insurance company on the planet, operating in over 130 countries, employing over 100,000 people, insuring everything from airline fleets to Hollywood films to the lives of ordinary Americans. By the early 2000s, AIG was worth $180 billion. It was one of the most trusted financial institutions in the world, and it was about to make the most reckless bet in financial history. Inside AIG's headquarters in London, there was a small division called AIG Financial Products. It employed fewer than 500 people, but it was generating billions of dollars in profit every year. How? By selling something called credit default swaps. Credit default swaps were essentially insurance policies on financial products. Banks that held mortgage-backed securities, bundles of home loans, were worried about losing money if those mortgages defaulted. So they bought credit default swaps from AIG Financial Products. AIG essentially promised to pay the banks if those mortgages went bad. In return, the banks paid AIG a premium every year. It was like selling insurance on a house, except AIG was selling insurance on trillions of dollars worth of financial products. And unlike regular insurance companies, AIG was not required to set aside reserves to cover potential losses. They collected the premiums, they booked the profits, and they assumed the housing market would never collapse. The man running AIG Financial Products was a trader named Joseph Cassano. Cassano was aggressive, confident, supremely self-assured. He genuinely believed the housing market was safe, that the mortgages underlying all those securities would never default en masse. In 2007, as the first cracks appeared in the housing market, Cassano made a stunning statement. He told investors it was hard to see how AIG would lose even $1 on its credit default swap portfolio. Not $1. He was catastrophically wrong. By 2007, the subprime mortgage market was collapsing. Homeowners who had been given loans they could never repay were defaulting in massive numbers. The mortgage-backed securities that AIG had insured were losing value rapidly, and the banks that had bought credit default swaps from AIG started coming to collect. Goldman Sachs, Deutsche Bank, Societe Generale, Merrill Lynch, they all came knocking. Pay up, that is what the contract says. But AIG did not have the money. They had collected billions in premiums, but they had not set aside reserves to cover the losses because they never believed the losses would come. Now they were coming, all at once, from every direction. By September 2008, AIG was on the verge of complete collapse. The company needed cash immediately, but no private lender would touch them. Who lends money to a company that owes trillions in potential insurance claims? AIG called the Federal Reserve, and what they said sent shockwaves through the government. If AIG collapses, every major bank in America collapses with it. Goldman Sachs, Morgan Stanley, Citigroup, Bank of America. They all held credit default swaps from AIG. If AIG could not pay, those banks would take catastrophic losses. Some would fail immediately. The credit markets would freeze completely. ATMs would stop working. Businesses would not be able to make payroll. The entire global financial system would seize up. Federal Reserve Chairman Ben Bernanke later said it was the most frightening moment of the entire financial crisis. Worse than Lehman Brothers. Worse than Bear Stearns. AIG was the one that could have ended everything. The government had no choice. On September 16, 2008, just 2 days after Lehman Brothers filed for bankruptcy, the Federal Reserve announced an emergency bailout of AIG. $85 billion initially. Then more money came, and more, until the total reached $182 billion. $182 billion of taxpayer money, handed to a company that had made reckless bets with no reserves to cover the losses. The government took a nearly 80% ownership stake in AIG in return, effectively nationalizing the largest insurance company in the world. It was unprecedented, extraordinary, and deeply controversial. The American public was furious, and that fury only intensified when the details of AIG's bonus payments emerged. In March 2009, just months after receiving the government bailout, AIG paid out $165 million in bonuses to employees of AIG Financial Products, the same division that had created the credit default swaps, the same people whose reckless bets had nearly destroyed the global economy. They received bonuses paid for by taxpayer money. President Obama called it an outrage. Congressional hearings were held. AIG executives received death threats. The public could not comprehend how people who had caused so much damage could be rewarded with millions in taxpayer-funded bonuses. AIG CEO Edward Liddy, who had taken over after the bailout, went before Congress. He sat at the hearing table and tried to explain the unexplainable. Why people who had nearly destroyed the global economy deserved million-dollar bonuses. He had no good answer, because there was none. Joseph Cassano, the man who ran AIG Financial Products and oversaw the credit default swap portfolio, left the company in early 2008 before the full collapse. He received a $34 million severance package. He was never criminally charged. He was never prosecuted. He kept his money. He walked away. The $182 billion of taxpayer money was eventually repaid by AIG. The government actually made a small profit on the bailout when all was said and done. But that does not change what happened. An insurance company made trillion-dollar bets with no reserves to cover potential losses. Regulators watched and did nothing. Rating agencies gave AIG's financial products AAA ratings they did not deserve. And when it all collapsed, ordinary American taxpayers were handed the bill. The AIG scandal led directly to the Dodd-Frank Wall Street Reform Act of 2010, the most sweeping financial regulation since the Great Depression. New rules on derivatives, new oversight of financial products, new requirements for reserves, all designed to make sure what happened at AIG Financial Products could never happen again. But here is the uncomfortable truth. The same culture that created AIG Financial Products still exists on Wall Street today. The same pressure to generate profits at any cost. The same assumption that the market will always go up. The same belief that the government will step in if things go wrong. Because it always does. That is the real lesson of AIG. Not that one reckless division brought a company to its knees, but that the entire system was designed to reward recklessness and punish nobody when it all went wrong. AIG survived. It was restructured, reprivatized, eventually returned to profitability. The company still exists today, still selling insurance, still making money. Joseph Cassano kept his $34 million. The bankers who bought AIG's credit default swaps collected their payments courtesy of the American taxpayer. And the $182 billion that ordinary Americans paid to clean up this mess was never paid back by the people who caused it. This is boardroom fallout, where billion-dollar lies come to light. Next up, GameStop. The story of how ordinary people on Reddit took on Wall Street hedge funds and almost won. Subscribe now so you don't miss it.